In this video, I'm going to explain how you can make some additional income using stocks or ETFs that you already own in your brokerage account. For this example, I'm going to use VOO, or the Vanguard S&P 500. I'm also going to use VTI as an example, but this will work with any stocks or ETFs that you have in your brokerage account. You need to own 100 shares of the stock before you can do this strategy. This is called a covered call strategy, which means you're going to sell a call option using the 100 shares that you own. Now, if you're anything like me and you have been into the FIRE movement, you know what VOO is. So I have been stacking VOO and VTI for a long time now, and I have hundreds of these things in my brokerage account. As a way to add additional income, you can sell these covered calls on these stocks. So taking a look at VOO, it is at its all-time highs, or very close to it. That is actually a good thing because we want to be looking for big green candles before we start selling these covered calls. The higher the share price, the safer it is to sell a covered call on it. And if you sell it on a big green day, you're going to collect more premium for selling your call option. So for this strategy, even though it's an option strategy, there's very little risk to it. Options are not all about gambling and YOLOing. A lot of times, options can generate steady income in a safe way. Now, taking a look at the options chain for VOO, we're going to sell a call option and we're going to pick the expiration date, which is February 16th, so about 29 days out. Now you're going to see a bunch of numbers here. The main one is the current share price for VOO. It is at $438. Any of these prices down here, so all of these options, they're considered to be in the money right now because they are below this share price. Now we're not really interested in anything in the money. We want to be selling an out of the money call option. Specifically, we're going to look at this $450 strike price. And you can also see there is an actual price here for the contract. It's at $1.75. Now with options contracts, one options contract represents 100 shares of the stock or ETF. So you need to have at least 100 shares of VOO before you can sell a covered call on it. Using the expiration date, February 16th, if the price of VOO goes from $438 up to $450, then you will be forced to sell VOO for $450, and you will be forced to sell 100 shares of it. For your troubles, you're going to be collecting this premium, which is $1.75 per share. If you multiply that by 100, it would be $175. So you're essentially getting paid to sell your shares at a higher price than it is now. What happens if the share price does not go up to $450? If the share price only goes to $445, then you keep your shares, but you still collect this premium of $175. That is actually the scenario we want because that is a win-win for us. We keep our shares and we collect the premium for doing not much work. Now, if we expand on this, we'll see a few more stats, one of which is the chance of profit. So based on some calculations, there is an 81% chance that this does not happen. So there's an 81% chance that on or before February 16th, the price of VOO will not skyrocket to $450. Either way, if it happens or not, you're going to get paid the $175 per options contract that you sell. If we take a look at VTI, we get a similar setup. VTI is currently at $236. I have sold a call contract for $245 strike, and the price right now is at 60 cents. So 60 cents times 100 is $60, and you multiply that by the amount of contracts that you sold. In my case, I sold 4 of these. Looking at the chance of profit, there's an 86% chance that this does not happen. And again, I don't want this to happen because I want to keep these shares for as long as possible. I want to keep on to my VTI and my VOO for as long as possible to keep generating dividends, and I can keep selling covered calls on them to generate this additional income. Let's take a look at some of the actual numbers that we have. For VOO, I sold 2 contracts at 100 shares per contract, so I needed to have 200 shares of VOO in my brokerage account, which I do. The price I got was actually $1.27. Had I waited till the end of the day, I would have gotten a better price. Now remember, we have to multiply this by 100, so it would be $127 times the 2 that I sold. Now looking at VTI, it's a similar situation where I sold 4 of these contracts, so I needed to have 400 shares of VTI in my brokerage account, and I did it for the price of 45 cents. So 45 cents times 100 times 4 for VTI is 180. the VOO example, I got $254. Depending on the ETF or the stock, how liquid it is, you can do it every month or every week even. So if we add those together, we get $434. That is the total amount that I have collected. Now I'm doing this in Vanguard, which is not the greatest platform. They charge a high commission for options, and Vanguard isn't really made for options trading. If you do this in a Fidelity or a Robinhood, you get a much better commissions rate. But these are in my Vanguard account, and Vanguard charges $1 per contract. So I have to subtract $6 because I sold 6 of these things, which gives me $428 for the 30 days till the expiration date. If I can continue to do this throughout the year, I would get $5,136 per year just from selling these covered calls, which is a pretty good extra bump in income. Now this will be addition to any dividends that you may be collecting already. This money will just be showing up as cash in your brokerage account. So of course there are some risks involved. The first risk, or rule of thumb really, is that you want to pick a strike price that is above your cost basis. So I have had these VTIs and VOOs for a long time, so my cost basis is very low. But you always want to have a strike price above the cost basis. That way you never actually lose money. You never get a realized loss. So just by simply having your strike price above your cost basis, it's going to protect you from any major losses. The second big risk is that you may lose your shares. So if that strike price and that share price do meet up at the time of expiration, your shares are going to be called away. That's why it's called a call option. Your shares are going to be called away. You're going to be forced to sell however many contracts that you sold worth of it, and you will lose your shares. Now you're going to get paid for those shares, but if you're like me, you want to keep on to those shares for as long as possible. Which brings us to the final risk, is that if you really want to protect those shares, you're going to have to close out those positions. And if the prices do meet, if the strike price and the share price do meet, that means your options contract has not expired worthless. Your options contract will be above what you paid for. That also means you're going to have to pay money and lose money to protect your shares. As I mentioned before, this works for any stock or ETF, so I'm doing this for PayPal as well. I do own 100 shares of PayPal, and I have done it for tickers such as SPY and QQQ. SPY is another S&P 500 index fund, but it is a lot more liquid than VOO, which means you have a lot more options. So you could sell a daily one if you wanted to, or a weekly one. VOO isn't as liquid as this SPY, so you can only do that kind of in a month-by-month basis. If this video was helpful to you, please give me a thumbs up and subscribe to the channel. Thanks.